Crypto long and short, 4 metrics that show how the current Bitcoin rally is different from 2017. Crypto markets have historically been led by retail investors, with professional investors following. Is that changing? After all, high-tech innovation in the past 15 years has executed an opposite about-face, flipping an enterprise-led pattern into a consumer-led pattern. Retail's lead was evident in the fourth quarter of 2017, as media hype soared alongside the price. There's no doubt the retail hype is quieter this time around. CNBC had nearly 100 Bitcoin BTC, plus 2.07% headlines in the first half of Q4 2017. These past 6 weeks, as Bitcoin ran to a new all-time high in market value, it has put up less than 40. Where the hell are Davy Day Trader and the Robinhood effect investors? Did their stimulus checks run out? It's premature to diagnose a secular trend in crypto investing, mostly because the retail-institutional dichotomy is problematically simplistic. Below, I'll run through 4 dimensions of the market that show how the participants in this run-up are behaving differently than investors did in 2017. Bitcoin whales and trading versus holding. Bitcoin versus Ether and everything else. Regulated versus offshore futures markets. N. America versus E. Asia investors. 1. Bitcoin whales and trading versus holding. The number of addresses holding at least one Bitcoin increased at an unrelenting pace from the end of 2013 to the 2018 crash. It picked up again in 2019, then leveled off again this spring. This is different from the end of 2017, when it soared to a peak with the Bitcoin price. Compare that to the number of what we could call Bitcoin billionaires, addresses holding at least 1,000 BTC. These whales were selling into the run-up in 2017. This time, the Bitcoin blockchain's Forbes list is growing, not shrinking. Address balances must be taken with a grain of salt. Addresses does not equal entities. Behavior is a better signal. If there be whales, where are they swimming to? Wherever they winter, they are bringing their Bitcoin bags along. The orange coin is accumulating more in wallets that historically buy and hold, and less in wallets that have shown a tendency to trade. Twice since 2017 a slowing in holder accumulation has been a leading indicator for the market top. In 2020, it shows no sign of slowing, yet. 2. Bitcoin versus Ether and everything else. The 2017 bull market is remembered as a phenomenon driven by enthusiasm for initial coin offerings (ICOs) on Ethereum. However, by the time the frenzy reached its fever pitch, Ether (ETH) had largely completed its run. At the midpoint of 2017 Q4, Bitcoin returns were 23.9%, Ether returns were 6.9%. It was Bitcoin's Q4 catch-up run that fed the bulls. Contrast that to 2020 and the similarities and differences are telling. Again, Ether led the run-up, but this time it's keeping pace with Bitcoin, returning 23.2% so far on the fourth quarter to Bitcoin's 28.4% even before it crossed $500 early Friday. If 2017's pattern repeats, the Bitcoin bulls may have a longer range to run. So, are crypto markets consolidating? The answer is yes and no. Bitcoin dominance, the orange coin's share of cumulative market cap, is in the high 50s. Usually, that means a shorter list of assets that compose the bulk of the market. Not this year. Top 5 assets in the CoinDesk 20 are growing with Bitcoin, but the long tail is now more fragmented than it has been since the aftermath of the 2017 bubble. This tally includes stablecoins and other pegged assets. 3. Regulated versus offshore futures markets. The institutions are here, chorus can sing about the growth of the CME Bitcoin futures market, signaling increasing demand for regulated exposure to Bitcoin via established operations channels. Open interest on the CME hit $1 billion this week, an all-time high. 4. N. America versus E. Asia investors. Parallel to the growth of CME futures is the flow of Bitcoin onto North American exchanges, and off of East Asian exchanges. To the extent exchange flows represent the activity of participants, East Asian investors have been selling Bitcoin into this bull market at rates never before seen. Meanwhile, North American interest in Bitcoin is greater than it was in 2017. One important caveat: the flows here may represent the preferences of traders more than the long-term activity of investors. The stablecoin daybook USDT, plus 0.05%. Conclusion. The takeaway: this bull run is indeed different from 2017, though that doesn't mean we won't see another peak and trough cycle. Signals that hint at the kinds of investors who are participating indicate we may be earlier in the cycle than we were when Bitcoin hit its all-time high 3 years ago. Bitcoin's history is full of narratives about upcoming shifts or regulatory changes that would change the market fundamentally. Those narratives have been overblown in the past, and they're probably overblown now. The same is true of narratives that foretell the dollar's demise. Are traditional financial markets burning down their own frat house? Maybe, but that doesn't suddenly transform Bitcoin into a safe haven or a hedge. The current patterns of new, larger and longer-term investors' growing involvement is likely to continue, but Bitcoin and down-market cryptos will be risk-on investments for the foreseeable future, and investors should continue to treat them as such.